public portion of today's IAC meeting. We had a productive session throughout the day that IAC members now have the opportunity to share with almost the entire board. Since this is being broadcast, we're going to go around the room really quickly so everyone can that's listening on the line can put a voice to a name or a name to a voice. And I remind you also to please use your microphone or that it won't get picked up. I can go first. I'm Jeff Brickman, Investor Liaison and Co-Chair of IAC.
Ryan Carter, FASB staff.
Daniel Verberg, FASB staff.
Sue Cosper, FASB.
Janet Pegg, Analyst, Zion Research Group.
Brian Kleinhansel with KBW.
Gary Buser, FASB.
Nicole Burnap with Glenview Capital.
Catherine Hensel, Private Investor.
Todd Castagno with Morgan Stanley.
Russ Golden, FASB.
Yoni Engelhardt, Shillett Forensics.
Mark Hamill, SA Research.
Jim Croker, FASB.
Trevor Harris, Columbia Business School.
Hal Schroeder, FASB.
Matt Schechter, Private Investor.
Marcia Hunt, FASB.
Stephen Yang, Private Investor.
Shandy Smith, Investor Liaison and IAC Co-Chair.
Great. So we also have an SEC observer on the line, and we did hear a few comments throughout the day that were probably a little bit outside of the FASB purview and maybe pointed more towards the SEC. So feel free to include comments like that as well as we go through the topics. For each topic, we're going to have a representative of IAC that's going to be a spokesperson who will summarize the feedback that we discussed throughout today. We'll also have opportunities for other IAC members to jump in and share their thoughts, and board members also will be able to ask questions for each of the topics as we go along. As for the first topic, we're going to look to try to recap a discussion that was quite productive from this morning that surrounded the idea of that you guys all have a little bit more visibility into the marketplace than sometimes we do, and in particular on revenue recognition and leases. We got some feedback from you all on areas where you were seeing things from the new from the topics that just went out. So for that, I think for revenue recognition, we're going to start with Mark Hamill.
Okay. Well, I cover technology, and I think there's still a fair amount of confusion out there regarding the impact of 606, particularly on companies that are heavily affected, such as software companies. Current disclosure that companies provide is essentially the net impact of the new RevRec on consolidated revenue, when as an investor, oftentimes particularly in software, people are focused on one particular line item on the P&L within revenue. And there are two factors that are coming into play with 606. One is the benefit from new transactions that are generally accelerated relative to 605. And then the second is the loss of essentially deferred revenue for those companies that adopt it on a modified basis. With a net number, it's confusing because I don't think people necessarily understand those two competing factors. So particularly for that first year, I think it caused a fair amount of confusion. I think it's still causing confusion. And I thought it would be very helpful to have more of a roll forward so you could see that broken out. And particularly if you could have it broken out by revenue type. Because again, if I take software as an example, most companies are either transitioned or in the process of transitioning towards a subscription model. And some of those companies bundle multiple categories of revenue within a subscription line. And so it'd be very helpful to see that impact again by line item so you could really focus in on the part that I think the street is watching very closely. Nicole, I don't know if you have any. No?
Any other members have any comments?
I guess just maybe on the remaining performance obligation, there was some discussion that it would be better or for enhanced disclosure around the timing of the potential amount of when the performance obligations would be recognized in earnings. And then potentially additional disclosures about some of the practical expedients in terms of if it's less than 1 year not being included in the performance obligation, as well as the details around the amount of pass-through revenue that's included in the estimated remaining performance obligation.
Mark, a quick question. Of the companies who do break out the subscription versus product, what percentage is that versus companies that don't?
In software, for example, I'd say the large majority are going to break it out because they want the street to look at subscription. But some companies will fold again, for example, on-prem together with pure SaaS arrangements within a subscription line, but they won't break out them separately. So people are seeing subscription growth when in reality, if you adopted 606 on a modified basis, for that first year, it looks like it's growing, but you're really recognizing the on-prem deals like a perpetual deal. So it's not true growth. But I think most companies are breaking it out because they want you to focus on subscription.
Sue?
Maybe just a question for Nicole on the remaining performance obligation and the timing of when that will be recognized. Are you thinking about that from a qualitative perspective or?
No, more of a quantitative perspective. There are some companies that selectively disclose like they will recognize in the next 12 months. Some companies that give you an itemized breakdown of each year, the percent that they expect to be recognized, and other companies don't tell you anything. And so
Are they mostly sharing that in their analyst calls?
No. I can only think of one or two companies that talk about remaining performance obligations in their earnings calls. They're still focused on like a bookings number. Most companies are only talking about remaining performance obligations within the actual 10Qs. Okay.
We also had a similar discussion for leases, and for that, Todd Castagno is going to lead us off.
Yeah, great. So early days, as most companies have adopted the new standard of Q1 2019. So we thought we'd share some observations from the market and from different types of investors and data vendors. First of all, I think there's most companies have telegraphed the impacts fairly well, particularly on the balance sheet side of the equation, with larger assets and liabilities. Gave investors some foresight into what the outcome would look like upon adoption. There tends to be a little bit more focus on the balance sheet items, and particularly I'd say on the liability side. Investors have long used heuristics to come up with the debt-like liabilities, 7-8 times rent. I think what we're finding is a transition towards using the reported amount as the liability base versus a heuristic. So we've seen that incorporating that into debt directly, also into derivative metrics such as enterprise value for firm capitalization. We've seen companies adopt that as well for their internal, for instance, return on invested capital or return on asset amounts. They're using the new disclosures as well, and wait to see firm specific performance metrics as well. Another important constituency, an intermediary between preparers and investors, is the data aggregators, data vendors. There had been mixed practice up until recently, where some vendors would include the assets and other assets and the liabilities within other liabilities. There appears to be transitioning where the liabilities are included within debt metrics and then derivative metrics, such as, again, enterprise value. The assets being commingled with PP&E. So they're normalizing the disclosures and allocating these different disclosure components within those hierarchies. Other, I'd say, issues or observations is one, IFRS comparability has become somewhat of a topic, given that they have a different recognition model, and doing cross-border comparisons of metrics can be more difficult and require further adjustments. Other surprises, well, I think investors understood that the standard would bring kind of right sizing of the balance sheet. There was the view, particularly with US GAAP, that the income statement recognition pattern wouldn't change much, and for the most part, that's true. I'd say there have been a couple of pockets of potential surprises, such as sale leasebacks, where companies had been amortizing that gain as a source of income into future periods, and companies, upon adoption, recognize that gain in retained earnings, and therefore their guidance had changed to a lower amount to effectively remove that future gain within their earnings. Discount rate variability. I think some investors might have been surprised that by the amount that's been disclosed. We've seen kind of variety of ranges. I'd say anywhere on the low side for, call it, 2.5%. Investment grade companies around the 4% median, whereas if you go to the non-investment / junk category, you'd have a discount rate of 7%. So there's been some questions on, is the nature of the economic transactions a lease? Are we really getting a different variability there, or should it be more on the credit quality of the lessee? And then capitalized amounts, I think generally we're in line with people expected. There are a couple industries where, particularly airlines, where the amounts came in a little bit different than expected. And I think that's perhaps an overlooked difference between contractual lease payments on 605 versus 606. That said, I do think those companies disclose the reasons why fairly well. Disclosure, I think generally it's been very supportive. Discount rate, the weighted average lease term is very important. I think that's a great add, along with obviously with the discount rate, but that weighted average term, I think it really helps you differentiate between companies that have similar business models. One does long-term leases, one does short-term leases, and it contextualizes the amounts being capitalized. Maybe I'll pause there.
Anything else to add from any other IAC members or questions from the board? Pretty comprehensive. Okay, great. So switching gears, we're going to talk a little bit about disclosures by companies around government assistance. And Matt Schechter.
Yeah, so we discussed this morning government assistance in various forms. And so this is an area I think where, broadly speaking, the IAC has kind of come out, where we're kind of questioning the materiality, kind of broadly speaking about, how much is this issue kind of worth in a general sense in the results of the financials, and whether relative to the amount of work to be done on the issue per se. I think some of us have maybe seen this issue internationally, but obviously haven't looked at it domestically because under IAS or IFRS, you've seen disclosure of government grants before. I think one of the questions we kind of raised earlier was kind of in the context, are there specific industries that perhaps this will be applicable to? So in real estate with REITs, or perhaps large companies with large real estate platforms where the sort of negotiation of, let's say, a tax abatement is one example of government, effectively a government assistance, would be assessed. And so the question would be, how material is this to the ultimate results? And I don't think we know yet. And then obviously I think there are other industries or other specific circumstances where this could come into play as well.
Yeah, so when I covered the defense industry, and there are different types of government assistance that needs to be, recognized, and it's important to realize that there are various industries depending on biotechs which benefit from Department of Health grants to defense companies or even financial services companies. And this is becoming a more important topic, especially with renewables, as government, international government, as well as the U.S. government provide credits for renewable resources. So.
Trevor?
Just to add, I just want to make sure we don't leave the wrong impression, is that there was some concern, as Matt alluded to, about the potential cost of doing this. But for those companies that don't have government grants, it's not an issue. So those who have, we would still be concerned about the sustainability of the grant to whether it's the cash or the revenue or the income. And so it is critical to get that information. And I think we talked about it being more quantitative than just descriptive, because it does impact or can impact significant parts of the financial model. So to the extent that this exists in these sectors or these companies, there seemed no reason not to do it. And having been on the ISB's advisory council when this was first discussed at that level, it was largely as they brought in more international jurisdictions that it was such a significant part of the business or the operations of these entities that you couldn't not do it. And to the extent we have these global corporations that are being incented to invest through various governments, grants or other actions, it doesn't make any sense not to do it, frankly, if you want to understand the business.
Sue?
I just have a question, because I had the pleasure of sitting in on that session, and we covered a lot of ground in terms of different types of government assistance. And I know that there were some concerns about perhaps the informational utility of loan guarantees and discounts discounted loans, and I just wondered, from a scoping perspective, we talked a lot about tax abatements, and we talked a lot about, different kinds of assistance that, in terms of the sustainability of it, and I wondered if the members had similar views around loan guarantees and loan discounts in terms of scope of this project.
Catherine, you want to?
I guess I made some reference to that, and I had spoken specifically about TARP as one of the biggest government bailouts that we've seen in the U.S. And of course, in a circumstance where the transactions are as large as that, that would fit importantly in a standard like this. But I also voiced some concerns because the financial sector is inextricably entwined with the U.S. government from the standpoint that the banking system relies on the Federal Reserve as the lender of last resort, that Fannie Mae and Freddie Mac continue to provide an implicit government guarantee to the large parts of the mortgage market. We have the Federal Home Loan Bank system as a backstop for savings and loans and other large mortgage lenders. And you even see this in agriculture. And I felt that that it would be next to impossible to try and attempt to put some level of value or assistance on any of that, and that maybe that to extend that far, the scope would be too great. But to focus, as FASB has up to this point, on keeping it very focused on large transactions that are truly very, very material and appear to be like one-offs as opposed to many small things, makes more sense.
So we didn't discuss this in too much detail in the session, but having thought about it since then, I think you have to be a little circumspect even with that, because if your loan book is primarily at the level that it is subject to the guarantees of one of these entities, then identifying that separately from the loans that are not subject to that helps you understand the business model. So it may not be that it gives you, 22 basis points of support, but the fact that actually this part of our business exists in part or is sustained in part because we're getting the support, because if the politics changed and those entities suddenly disappeared for whatever reasons because they may be privatized, then your business model is going to change significantly. So, it's a fine line, I understand, as you scope it, but it is part of how you operate your business. And there is a differentiation across companies when you do it, if you don't.
Nicole?
Yeah, I think in terms of like an entity that might go away and is at the whim of politics, we mentioned the Export-Import Bank. That's been mentioned in state aid cases and is providing some certain companies competitive advantages. So I think those types of disclosures would help investors assess the risk that's associated with that subsidized funding to their customers go away. I think additionally we talked about in terms of the scope is how do you exclude income taxes from the definition of government assistance. There seemed like there could be some circularity into like what's included or what's excluded, and something that comes to mind is the European state aid cases right now, and that there's like a operating expense / tax question, and it does become very circular. So when we're rethinking about rethinking about government assistance and how that interplays with taxes, maybe we should, not necessarily exclude income taxes from the scope.
Sandy?
Well, I was just going to raise the issue that I think Todd said there could be some definitional
issues with respect to income taxes and what is and isn't. So if you could just speak a little bit more to that. And also on scope, Janet raised a good point that sometimes laws are written for one company or a very small group of companies, and that we should be careful that things aren't getting caught up in that and avoiding the disclosure we're seeking just because of that.
Yeah, I think since the proposal, or as it stands now, the scope excludes income taxes, I guess just to be cognizant that I don't think that's necessarily as black and white as it sounds, and taxes are evolving, and I know the board has actually addressed this issue in the past of what is an income tax and what is not. What is you can go as recent as the House Republican tax bill with the destination-based cash flow tax, right? There's one argument that that's a cash flow tax, that's not an income tax. So there's different permutations around the world, digital taxes, turnover taxes, and just to be cognizant of scope issues. If definitionally one form of assistance fits outside of an income tax or inside an income tax, that can also affect obviously the disclosure here, but also the presentation. Whereas a non-income tax obviously is within operating profit, and income tax is below the line. And so you might have diversity in practice based on the differences of opinion of those taxes.
Janet, was there anything you wanted to add to what Shandy was saying?
I think Shandy pretty much covered it. It was just the fact that you had to be careful in your scope that you included things that really targeted specific companies or specific time periods, so that even though it might be viewed as an income tax benefit.
Anybody else? Okay, great. So we're going to move over to segment reporting now. We had a very spirited discussion this morning with pretty much everyone being very actively involved. And to start us off, we're going to have Yoni Engelhardt.
Yeah. So the committee considered two potential approaches towards improvements to segment reporting. The first approach involved adding 4 items to the disclosure list that already exists. The second approach was more of a principles-based approach that encourages companies to disclose significant items, including segment expense categories, asset categories, and liability categories. And the group had a spirited discussion on this, which was mixed in terms of the preferred approach. There was general agreement that the additions to the disclosure list would be valuable, but also concern that these requirements might encourage companies to collapse into fewer segments due to concerns about sharing proprietary information or just generally disclosing more information than the companies would prefer to. There was also general agreement that the principles-based approach on paper would align investor reporting with the intent of the CODM model, but also widespread concerns that in practice we were skeptical, or our group was skeptical, that this would actually happen, that the same metrics being used internally would in fact be shared through the disclosure under that second approach. And that raised 2 kind of broader issues that we had discussed around segment reporting. The first concern was that there seems to be some disconnect under the CODM management model, that it doesn't seem like the metrics that are being prepared internally are necessarily being disclosed in practice. And there wasn't generally confidence that that system is working effectively. And the second issue that was raised, which also may be outside of the scope of this proposal, but is very much related, is that there are companies primarily report to investors on earnings calls and other communications to investors, segment reporting on a non-GAAP basis. And so improvements or potential improvements to the GAAP reporting and reconciliation of segments may still leave something to be desired in a way of bridging the numbers, the figures inside the documents with the figures that are commonly being used in financial analysis, in particularly in segment analysis.
As I said, there was a lot of discussion. Or any other points any IAC members want to bring up before we see if there's any questions? Trevor?
I just want to make sure that one of the things that Yoni said is emphasized carefully is different companies will have different elements that are significant. And I think everybody expressed the desire to have more on the expense side. Making it too specific, like cost of goods or cost of revenue, is potentially too restrictive, or certain other categories that you were suggesting, some of which, like the cash flow number, I think different people have different views of what cash flow is. Some of us are very cynical that that is done on a segment basis in the way companies are managed. Having said that, the real issue is that, and this is the point I wanted to emphasize, is it's very hard to believe that chief decision makers are not looking at segmented data beyond those categories that exist today. And it's very difficult to believe they would go to a single segment model. So the issue has to be in the enforcement or the imposition of disclosing this. And people probably hide behind materiality or lack of competition or giving away competitive advantage. But that's where I think several of us think, is the real crux of the question. Why are we not getting what actually managers are doing, given that that's what the standard seems to be requiring? And that's why we would move away from, some of us would move away from the specifics. Tell us what you're actually using for your business.
Todd?
So somewhat tangential to the segment discussion was in terms of emerging information needs from investors is really around geographical exposures, and particularly given where we see some of the gyrations in trade and taxes and evolution, investors may not believe that they have the full picture of their risk exposures on a geographic basis, where supply chain risk may be. And so that's been an evolving topic. I think we've discussed it here in the IAC in prior occasions, particularly on the income tax front. But that logically extends to also foreign currency exposure as well. And I think having a better geographic disclosure, and perhaps this is outside the purview of the standards, or it can be improved through MD&A. I think just generally that theme has percolated.
Is there anything else, Trevor, you wanted to add on currency? Or?
The only thing I would add to that on currency is, based on some survey work we've done with treasurers and CFOs, they often don't understand themselves and don't get the disaggregated information themselves. So it's a problem that exists in the whole system, so to speak. But there's a lot more volatility there than actually we are able to see from the outside.
Matt?
I think the other thing I would point out too is that obviously from an investor perspective, if investors know that a company has a number of or a couple of material segments but then doesn't break them out, when there are surprises in the financial results, whether it's revenues or margins or whatever, it's kind of hard for them to kind of independently kind of verify, if the segment data isn't there, what the problem is. So either they have to take the company at their word at what they say, or the company doesn't give details. So by the segment disclosure should enable the analysts, investors, to be able to kind of address those material questions.
Any questions or clarifications from any of the board members? Okay, with that, we'll move on to the last topic, which is going to be vintage disclosures for write-offs and recoveries for financial instruments. And Brian Kleinhensel.
Yeah, so I think brought before the IAC was really two pieces of this problem here. One was whether or not vintage disclosure would be useful and should be required. And then secondly, if given vintage disclosure, would you need gross write-offs and gross recoveries as well by origination year? And so I think this goes back to within the CECL, there was an illustrative example of vintage disclosure, which wasn't actually in the text itself. And I think taking a step even further back, throughout the whole proposal of CECL, there was always two things we're always looking for. One was a roll forward by loan category by year, and that had always been sought since the beginning. The second piece also was the ability to do vintage analysis, meaning getting originations by year as well as gross charge-offs that apply to those origination years. Now, the roll forward really isn't happening at this point in time, so that makes getting the vintage analysis all that more important. So I think when you look at what was actually published, I think we see the choice between vintage analysis and no vintage analysis as a technicality, really. It's what was in the illustration, is what we were always intended to receive in as final disclosures from the preparers themselves. So the illustration with vintage disclosures was supposed to be the standard disclosures we're going to get, and we would urge FASB to make sure that that is something that we get as end users here of these financial statements, because that really, the vintage analysis allows us to then generate loss curves, and that goes into the second part of the question, which was what could you do with gross write-offs and gross recoveries? We would say of those two, if we had to pick, gross write-offs would be the one that's more important of those two, because that does allow us to build out the loss curves by vintage. And we really are doing that as a measure of evaluating management's quality of underwriting at that point in time. We often look as gross write-offs as a measurement of underwriting quality, whereas recoveries really could be pertained to the workout group and could come in at a much later point in time, and really could obfuscate the actual underwriting results from the write-off. So I think at a minimum, we would urge to get the gross write-offs. If gross recoveries is possible, that would still be accepted and possible. But at a minimum, we would want the gross write-offs, and we certainly do want the vintage to be included as a standard disclosure.
So what's your response when preparers say, but only giving you the gross charge-offs, which wouldn't be that difficult to provide by vintage year, without the gross recoveries by vintage year would be misleading? That they want to provide both, but providing the gross recoveries is difficult and would require, a lot of effort. So what they're saying is, we don't want to mislead you. Therefore, we don't want to or think it's beneficial to provide necessarily either one.
Right. Well, I would say, we still need the gross recoveries, and we get the gross recoveries today. Right. So within that disclosure, we could still come back with something that applies to vintages if we needed to. It'd be very hard to do by ourselves to take one current year and try to parse that back to individual years. So that's almost impossible to do. We really would need the companies to be able to provide that. There is an understanding that these can be lumpy, right? That you could get a recovery in 1 year that applies to something that happened 3, 4, 5 years ago. But it's that underlying trend of the actual losses of those loan portfolios that you originated. That information would still be available. I mean, you could run into situations where you have sales of loans, and I understand it could be a challenge in some parts of aggregating that information, but it still should be possible at this point in time. But at a minimum, I don't think net charge-offs is a way to resolve that, because if you look back at points in time, it's helpful for the current year. But if I'm looking back at what happened 3, 4 years ago with someone new to analyzing a company, that net charge-off number is only painting part of a picture, potentially. It's not showing what the original gross write-offs were, then subsequent recoveries that happened maybe 2, 3, 4 years later. So I'm only getting part of the picture. It's going to be much harder to, see the full aspect of what happened in that origination year and how it played out over time.
Al?
Brian, two questions. The first is more of an observation, and I want to understand the value of the charge-offs or the write-offs versus the recoveries. My kind of quick of the back in the envelope calculation was during the 10 years after the crisis, charge-offs versus recoveries was roughly 10 to 1. For every dollar of charge-offs or write-offs, you had a recovery of 10 cents. And so if you only had one number, I think I heard you say charge-offs would be the number you'd want. You could still build a loss curve, that 10 cents of recovery for every dollar of charge off wouldn't affect that loss curve that much. Is that
Yeah, it would.
fair?
Yeah,
Okay.
that's fair.
All right, so that was kind of the thought process. And I guess the other observation is that recoveries tend to come significantly after, sometimes years after, I think, what you said, the charge off. So again, it's gotten so disconnected from the event that led to the charge off that, yeah, it's great you get some recoveries, but it's not going to affect the analysis, was basically what I was hearing.
Yeah, that's it. When you think about it, we think about it as collateral-backed loans, and so that once the banks take possession or any financial institution takes possession of the actual collateral, it could take years to go through a court system, which is what we saw post-financial crisis, and that was 4 or 5, sometimes up to 7 years once the bank possessed the collateral before it actually was resolved and recoveries were received.
And sometimes the recoveries can affect multiple loans. They could be in different products, different categories, and would kind of force the banks to allocate out to. I mean, I can see some issues there. The other issue is charge-offs. One of the arguments that has been made by the banks is that we don't evaluate all of our products by charge-offs. Some are delinquencies. There may be other methods and things that we look at. Do you see charge-offs as kind of a unifying factor that would add comparability between banks and products? Or if they didn't do charge-offs as a primary look into how they were assessing it, would delinquencies allow you to do a similar analysis?
I mean, they could, but there's also different parameters bank by bank as to when they would recognize a delinquency versus in other banks. That makes the comparability across banks challenging. We tended to see historically that the charge-off methodologies have been more consistent across the banks. So that does increase the comparability just by using charge-offs themselves. But charge-offs also recognize the basic economics or the cash flows on the underlying, in that those are cash flows not received, thus charged off. So it does match more to the cash flows.
And we didn't change the charge-off timing or anything. We didn't change anything about charge-off, so at least that would be a constant between the incurred model and the
that should be
CECL model. Okay, good. Thank you.
Gary?
This question to the IAC members. We know Brian's opinion. He was pretty clear. We find out which members think that the vintage disclosures are decision useful or are not decision useful. So how many members believe that vintage disclosures would be a significant improvement to your information set? So yes, no, and don't believe.
Almost all the hands were raised. Yeah, about
10 to 1 decided.
About 10 to 1. Yeah.
Yeah. It's not relevant to a sector or meaningfully relevant.
Any other comments, questions, clarifications? All right, with that, we're going to conclude today's IAC meeting. We want to thank all of the IAC members for their participation. We appreciate all the input. And as a reminder, our next scheduled meeting is taking place later in the year on November 12th, and we look forward to talking to you again then. Thank you.
Thank you.